Hi, Steve Van Metre here, and welcome to your Monday Night Premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets that really don't make a lot of sense. But today we have what I'll call special edition, why gold is following Treasury bonds, or if you don't like that way, how about why gold is following U.S. Treasury bond yields traded shown inversely. You can pick which one you want. It's the same exact thing. So I want to look at that today because it's really giving us a strong setup of what should happen with gold. We're going to take a look at how hedge fund managers are mispositioned on the gold market, why I think there ought to be a pullback before it takes off. And but before we do that, we've got to get this disclosure out of the way. The content of this video is provided as educational information only. Is not intended to provide investment advice. This video is not to be construed as recognition or solicitation by or selling security, financial by instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed via and dynamo do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. Whoa. Okay. So remember the gold playbook. I know this is really scientific, isn't it? So we identified that we don't want to see yields and consumer prices following simultaneously, but they're not. That's what's interesting. We're not seeing that. Now, what did we see in the CPI data? We saw it was down a little bit. Well, so let's go take a look and try to, when it comes to investing, there's one thing that I've learned. There are lots of correlations, right? Some people say, well, oil and the US dollar are always inverse. No, they are not. They are sometimes inverse. Frequently it traded inverse, but not always. And so one thing when you're looking at these relationships and trying to figure out, okay, is this something I want to invest in? And if it is, where do I want to stage my entry point? Where's my exit points? You need to try to understand the correlation. So one thing I just, like a little kid, right? Why, Dad? Why? Why does this relationship work? And where's the opportunity? So let's go and take a look at first consumer prices. So this is a consumer price index done as an annual percentage change or a year over year, which is exactly how the Fed will read it. And we saw in June it hit 1.66% or 1.7% rounded up. And what I did is I drew this blue line in, which is pretty much the average going back to, say, 2016-ish, which puts the average consumer price index on a year-over-year rate of change at 2.1%. Now, you can look at it and say, well, this is a downward trend. Yeah, it is. Does it mean it'll hold? Nope. This was a downward trend until it took off. So at the moment, we have to assume that consumer prices are flat. We just have to, right? I mean, we don't know this is a bona fide downtrend until it makes a major move down, because it could very well go up next month. So one of the reasons is, why is gold following Treasury bonds? Well, one, inflation is flat. Now, if you don't believe me, let's go, and I don't ask you to believe me, form your own opinion. Here is the gold chart. That's the red and green bars. And overlaid here is TLT, which is a long U.S. Treasury bond fund. I could have made that 7 to, well, actually, you know what? Let's do 7 to 10 year Treasury bonds. It should look nearly identical. So there we go, 7 to 10 year Treasury bonds. So what you can see is, other than this spike up here by gold, Treasury bonds, you can see the mouse over this purple line went down. Gold eventually came back down. They both bottomed. And then you could see they both kind of started rallying together. And now we see gold, shown here in the colored bars, looks like it's struggling to break out of resistance. And then when we look at bonds, we see it looks like they're about to take off. So we see there is a relationship between them. Is this a long-term relationship? The answer is no, it's just a recent relationship. And part of that is understanding where it comes from. Remember, gold playbook says gold follows inflation adjusted Treasury yields. So what is inflation? The year-over-year rate of the consumer price index. What if that is flat, as I've shown you? What if it's fairly flat? Well, then what's the variable? You got it. 10-year Treasury yield. Pretty cool, right? So that's what's going on with gold. We're seeing it follow that. And if we look, where is the chart? Here it is. So what that kind of tells us is if there is a major move in the bond market, either direction, that is a catalyst for gold, because we have to assume at this point that inflation is going to hold flat. And he said, well, but in monetary deceleration, Steve, consumer prices fall. And that is true. However, we have a monetary deceleration. At the same time, we're having a trade war, several trade wars. Those trade wars could keep inflation up. That could be interesting. We don't know. It could. This is not something the market's used to dealing with. So that is a factor that could keep inflation sitting up here. Means the only thing that should matter now is what the bond market does. So let's go and take a look at how hedge funds are positioned now that we understand that, and you'll see why they are wrong. So let's go and look at, now we didn't have this last week because it was a short week in the market and the data didn't come out right away. So this is now current as of last week as we would normally look at it. So if I was a hedge fund manager, and I am not, but if I was and I was trying to get gold to go up, and you can see, where's gold? So you can see they're taking extremely bullish position in gold. So the hedge funds are shown here, and speculators are shown in green. They're at one of their longest positions on gold they've had, so they're really betting gold's going to go higher. Well, if that was the case, then they need to see interest rates fall, right? Because if we know consumer prices are fairly flat at the moment, then that means that they should be betting interest rates are going higher, and they're not. They're betting that they should be betting that interest rates are going to zero or lower, and they're betting that interest rates are going higher. So you could see they're short the bond market, they're short 10-year treasuries. It doesn't make any sense from a gold perspective. Looking at 30-year bonds, they should also be up here. They should be betting on interest rates going down, so they should be showing the green bars up here. Nope, they're back short 30-year bonds. Again, it doesn't make any sense. They should also be betting the dollar is going to go down. Well, let's see if they're doing that. And the answer is no. They're betting the dollar is going to go up. Again, it doesn't make any sense. And then if we went further, if you want to see inflation go higher, which they actually would, they want to be long crude oil. They are long crude oil. The problem is it's not really doing anything for inflation. They've been long crude oil here for, our chart goes back to 2016 on consumer prices. You can see they've driven crude oil prices up, which is a pretty big component of the CPI. Hasn't really made a big difference. So we got this dip here, which probably corresponds to this dip here. Maybe, let's see, 17. Yeah, so we haven't really seen this big drop in crude oil prices hit CPI. It could be starting to now. There's a lag there for sure. So at the moment, we know that hedge fund managers are mispositioned. Let's take a look at for at least their gold longs. Maybe the rest of the stuff they're okay. What else we got here? So they're backing off their long S&P 500 positions. This is pretty interesting. Maybe they're getting a little fear of the market being overvalued, and they should, because going into second quarter earnings season, which again started today, the market is overpriced based on earnings expectations. They're massively overpriced. NASDAQ, they're betting long on NASDAQ. They're very, very short small caps, which is pretty interesting. And as far as volatility, they're short volatility. Now, if they really wanted interest rates to go down to push gold prices up, they would be long volatility. So you can really see how hedge fund managers are totally mispositioned in this market. But now that we understand why gold is following treasury bonds, it's because inflation is fairly flat. Now, if inflation starts to fall, then we need yields to fall faster. If consumer prices rise, hallelujah, because we know interest rates are going down. That is what happens during monetary deceleration. So this is really a good setup. And if you look at the big picture of this and think about why there's this big bullish case for gold, it's because interest rates in the 10-year treasury yields are headed probably back to zero at some point. In fact, I think interest rates are going to pull equity market and everything down as whenever they do break through that level of support that's sitting out there in the market. So let's take a look at that real quick, and let's remove this. So let's just look at, we'll look at 7 to 10 year Treasury bonds. I mean, you can see they're just sitting right here. This was resistance. These three lines were acting as huge resistance levels, and now they're starting to act like support because they got up here. They didn't break completely. They did break through, but sellers came in, and now the buyers are starting to put a floor here. This takes off. That's your catalyst for gold. Look at the long bond, the 30 years Treasuries, tagged the 50-day moving average and held, and is now, as of today, starting to rally back. Bingo. There's your catalyst for gold. Now, why do I think gold is due to pull back? Well, one, it can't get through resistance here. It has not been able to get through. The other thing is it tends to lag the U.S. Treasury bond market. Number three, it has not confirmed any of its major moving averages since breaking it. Number four, hedge fund managers are overextended. They have gone way long gold and it's not moving. And at some point, when it doesn't move, they'll get out. So I think there's due to be one pullback here. That would be the buy signal, because we know as the moment Treasury bonds continue head higher or interest rates go lower, it's literally going to put a fire under the price of gold. That's at least what should happen. And so we can look at the junior gold miners where I'm partial. We've got these big open gaps, 1, 2, 3 of them. Pretty unusual to have that many, but the moving averages are starting to head higher, which is positive. So it would not be unusual to see a move back down anywhere into here to support that at all, especially if the hedge fund managers went and got out and backed off their position. So that's kind of where I think we should see gold. Now, if all of a sudden yields start to drop, that's a signal that we got to get in. If gold drops and bonds start to rally and yields start to fall, it's a major buy signal. The only way this isn't a signal is if consumer prices take a big nosedive, but we won't have a consumer price update for a month. We will have what's called core PCE next week, but we won't have consumer prices until next month. So that's positive. And it's unlikely that yields are going to rise because we've seen the big banks are buying bonds. Now, the surprise today in the market, let's switch over, is oil and gas producing stocks, which everyone's been really bullish about crude oil. But look at this. We saw this double bottom here, right? Back in 2016. What looks like a big topping pattern. It rebottomed here. Everyone got bullish again, and now it's sitting like $2, $3 away in price off of that, not far. All the major moving averages are headed lower. This I found, which is cool. I've been looking for a free sentiment report so I could share this with you. Now, sentiment on the short term is saying that this is a bottom. It's probably not, but there's one or two things that are going to happen here. Either we're going to get confirmation of this 1, 2, 3 and have a 4 bottom, or this is going to come down here and break through. But I'm just surprised at today's big negative minus 2.7% move with everyone so bullish oil. I mean, we've seen some draws the last couple of weeks, and all of a sudden everyone's selling these stocks. Is kind of interesting. Now, looking at a longer term scale on the weekly, the sentiment is negative. So it's saying we're not at a bottom as far as sentiment goes, and that's really cool because what it's telling us is even as bullish as the positioning are, people aren't bullish that much, which is pretty interesting. And we're seeing the weekly moving averages are headed down. So again, a lot of this suggests that we are not at a bottom here for oil and gas producing stocks. And that's bad news for the markets. There's a big correlation between the entire oil industry and the U.S. economy. And what's amazing is the broad U.S. stock market has not even reacted to it, not at all. All right, so that's our update for Monday. We'll be back with you on Wednesday and see what we've got for you then. But for the moment, we now know gold is following yields. That's our signal. If yields completely break down, we have to buy. Otherwise, I suspect we'll see a pullback in gold. That will be a monster buy opportunity because it will be the last move, because odds are interest rates are headed lower. But due to the tariffs, consumer prices may not be. They should, but they may not be. And that then brings into the story of why we might get a major tailwind to gold in the form of a weaker dollar. I'm Steve Van Metre. Have a good evening. Bye now.